I'm going to share with you guys something stocks haven't done since 2001. And I'm also going to share with you guys two very interesting stats that go along with the volatility that we just saw last week. On Friday, we had a massive red candle. Then on Friday, they set the trap like I warned everybody about in Thursday night's video. However, do you guys agree with this statement? Forget the stock market's tumble. The Fed made the right move in a wild week. Do you guys think it was right of Jay Powell to come out as hawkish as he was? Because as we come over and look at this next article, the stock market needed a washout, what sentiment says about what comes next. And when we come over here and we start looking down through this article, something that I found that was very interesting. And it basically goes on to say that the S&P dropped 2.94% the day the Fed came out. It was the worst Fed day since 2001. We know normally the Fed does not like to surprise the stock market and gives the market exactly what the market wants. We look at how the fear and greed index closed out on Friday, closing out at 28. Keep in mind, on Thursday, we've seen it as low as 22 or so. Then when we look at the most recent investor sentiment survey, we've seen the bulls step down a little bit, came in at 40.7. However, look at the bears. The bears actually got a little bit less aggressive. They dropped 0.3%. And we had more traders fleeing into the neutral category and saying, I don't know what to do. Are we crashing lower? Are we going to go higher? But with a little bit of good news, we can see that, yes, again, the government averts another shutdown in the final hours like they always do. They drag it all the way out into the very end. So will this be good news for the futures markets at the Sunday night open, giving us a large gap? And if we do, will it bring us to some key levels and give us some great shorting opportunities? Now, let's come over and take a look at some breadth indicators, for instance. And I want to start off looking at stocks above the 20-day moving average. If we look at what we had out here this week, we actually dropped down into 7%. Very low number. Historically, when we get down towards that area, that's when we start to see bounces in the market. However, when we start looking at stocks above the 50, we did not yet reach that lower level, nor if we look at stocks above the 200 period moving average, we were nowhere close towards that lower level where we start to see major bounces out here in the stock market. However, when we come over and we look at our first stat brought to us by Wayne, I want you guys to go ahead and pay attention. When the trailing 12-month is greater than 15%, look at the stats from December 20th going into January 17th. We have been up 22 of those times, only down 3. That is a very bullish stat. And that also goes right along with the stat brought to us by Jason. And that basically goes on to show that when we go from the worst breadth in 90 days to the best breadth within 3 days, look at the stats. If we look at 1 week later, 70% of the time, we are positive. You look at 2 weeks later, not quite as good, but we are positive 65% of the time. And then 1 month, 2 months later, we're both up 80% of the time. Then we look at 3, 6, and 12 months later, we're up 85% of the time. So again, we don't want to be too fearful about the recent developments in the stock market. What we do need to be fearful of, however, is the yield curve. Look at the yield curve steepening once again on the move up. And when I say the yield curve, when I'm talking about the yield curve, I'm talking about the 10-year versus the 2-year. We can also see that across the 10-year versus the 3-month. And if we come over and look at the 10-year yield, look at what we have. We are breaking out above this recent swing high. And this could be a massive, large A to B equals C to D pattern on the way up. If we were to draw that out, we'd have something like this. The A to B leg is the impulse move. The corrective leg is the B to C leg. Then we project all the way up here, which brings us right around the 5% interest rate out here for the 10-year yield. If the yields go that high, more likely than not, stocks are going to come under pressure. As we come over and look at the SPY versus HYG, HYG being high yield bonds, notice how much of a cliff high yield bonds have fallen off. And we can actually see it starting to tumble before we ever had Jay Powell come out. We were already starting to see weakness show up in the high yield bonds. Now, did they recover a little bit? Yes, but not nearly enough. And again, this is another warning sign that we need to pay attention to. We also come over here and look at the Dow Jones versus the transportation index. we've had this declining trend line. We broke out. Now we're coming back to test it on the transports, and we can see the Dow finally starting to pull back. However, when we look at the Dow, look at how many consecutive down candles we had. And when I say down candles, I mean candles where we closed lower than where we opened up on the day. Friday, we finally get a bullish engulfing-ish looking candle. However, I'm not so excited about the wick that we have on the top, but look at the massive amount of down candles. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 down days in a row. When I say down days, like I said, I'm not necessarily saying we closed lower than the prior candle, but the fact that we closed consecutively lower than where we opened, I kept telling people, watch out, the Dow is likely going to bounce. And we can see the MACD indicator right now, extremely bearish at this moment, just getting below the zero line. Now, if you want a way to support the channel and you trade with prop firms like Apex, My Funded Futures, or even Take Profit Trader, use the links in the description box down below to get the best deals. But then we start looking at the 4-hour chart, and we see it starting to base out here just a bit. And on the 1-hour chart, we can see we had a little bit of MACD divergence. As we came down, making a new low out here, setting the trap on Friday, we see the MACD indicator failed to make a new low, and that was a common theme across a lot of the indices out here. Now, if you guys thought I was done with the bad news, not yet. We look right here, almost all sectors are considering job cuts, German bankruptcies growing by double digits. Now, you might say, Mike, that's over in Europe. I don't have to worry about that. We're over in the US or somewhere else. Keep in mind, once it starts somewhere, it's likely going to spread. Now, I know a lot of you guys think I'm always bearish the stock market. However, that's simply not the case. If you listen to the video that I released at 5 o'clock on Thursday, I talked about what I was expecting for Friday. I was expecting the market to come right back down, break this low over here, then potentially rally back up, trap in the lower level shorts. And on stream, we got a good chunk of this move on the way up. Now, if you guys want to make sure you don't miss the next time I go live, make sure you subscribe and you have the bell notifications turned on for all. When we look at the range that we saw out here on Friday, the S&P had a massive range. The range was 184.75 points from the low point all the way up here towards the high. We were able to take out that untested point of control at 58.68. We come over and we take a look at the SPY real quick. Let's start off by looking at the weekly time frame real quick. How did the weekly chart close out? Well, you can see one, we do have a buying tail on the bottom of that candle. However, overall, it was a very bearish week out here for stocks. We can see the MACD indicator on the weekly chart starting to turn down. We look over here on the daily chart. What do we have? Well, first, I want to go ahead and turn on the DeMark 9-count indicator. And notice right up here at the highs, what do we get? The 9 count, we go sideways, and then we start to drop. What do we get over here? 9 count, we go sideways, we get a little bit of a drop. Over here, 9 count, we go sideways. Over here, 9 count, sideways, we drop. And it repeats time and time again. Because if we scroll back down here, what do we got? 9 count, bounce. 9 count, consolidation, bounce. And that could be exactly what's in store once again. Are we going to get a 5, 6, 7, 8, 9? That could take us substantially lower than these lower swing points over here, going in and filling in the gap from election night. Before that, let's go ahead and pull up some anchored VWAPs real quick. I'm going to pull one up right from this swing point here. Then I'm going to pull another one up from the swing low right down here. And notice we are below both of those anchored VWAPs on the SPY. We also have the daily MACD indicator cross to the downside. Just below us, what do we have? We have a high volume node out here on the profile, which comes in at 570.93. If we get down here and we start breaking, watch for the swing point to potentially give way. And that could actually open up the door for a much deeper retracement. And what I would want to do is go ahead and pull a fib from that major swing low down here, all the way up to the swing high, and notice where the 38% retracement is, right near the high volume node. But we know the S&P loves to retrace 50% levels, and that would bring us down towards that next high volume node. Then as we go ahead and we measure from all-time high down to the 50% level, that would be roughly an 8% drop in the S&P. Now, is that crash territory? Absolutely not. It might seem like that, for how this year has played out, where we've had very minor corrections along the way. But even if we went even further, maybe down towards the 61.8, that would only be a 10% correction. However, if you're looking for the markets to be ultra bullish next year, That is not what you want to see starting to unfold when we should be having this Santa Claus rally. Now, when we come over here and we start looking at the 4-hour chart, MACD indicator is below the zero line. We look out here on the 30-minute chart and notice we had that divergence that we talked about earlier when we were looking at the futures markets. Notice we swept the lows, boom, we got right back into the range. However, something I want to pay very close attention to, and that is going to be the day of the Fed. If we can start getting above 50% of that nasty down candle, which is kind of where the anchored VWAPs are, then we have a shot of go ahead and reversing that whole entire move and going back and reclaiming the top of that candle and potentially making a new all-time high. However, there probably will be pullbacks back and forth along the way. And as we come over and we start looking at the futures markets real quick, notice this whole area of last week's profile, very poor structure. We actually have two separate minus development areas. I'm going to go ahead and mark those off on the chart right now. And what I want to look for is the first time we come up into a level, normally we'll get smacked down or we'll go sideways. You can see right here on Friday, as soon as we came up into that zone, bam, we got smacked right back down. Now, if we come into a second or third time, highly likely that level will then break and we'll start pushing towards the next minus development area. Now, those levels come in somewhere from about 6,049 up here to about 6,070. The secondary minus development area just above us will come in at about 6,098 to about 6,114. Then as we dive down, start looking at the daily profiles, like I said, we had a massive move on the way up. However, we have some minus development areas on the daily profile as well, which I will want to pay attention to. And we'll be talking about those on the live stream on Monday as well. Now, that first area is going to be somewhere from about 59.88 down here towards 59.80. Now, notice we already came into that zone once. We bounce. We're coming back into it a second time. We bounce a little bit. We come into it a third time. We're likely going to push lower, then start to come back into this other minus development area over here as well. Now, we can also pull our Fibonacci retracement from the swing low out here on Friday to the swing high. Look at where the 50% retracement level comes in. Comes in right at that minus development area. So we need to pay very close attention to it. Now, when we look at the daily volume profile levels, we have value area high coming in at 6,050.50. We're going to have the point of control coming in at 5962.00 with value area low being 5929.50. Now, I did forget to give out the weekly levels as well, which I don't really know that we're going to make it all the way up here towards the point of control or value area high. Point of control being 6131.75, value area high being 6163.75. Value area low coming down here at 5970.25. Now we come over and look at the economic calendar real quick. What do we have out here for Monday? We have the CB consumer confidence. Then on Tuesday, keep in mind, it is going to be a shortened day, half a day trading as it's going to be Christmas Eve. We have core durable good orders coming out. We have new home sales. We have the Richmond Manufacturing Index. So we do have a chance for some volatility out here on Christmas Eve. Will Santa come early? Wednesday, markets will be closed. It is Christmas. Then on Thursday, we have the weekly unemployment claims. Then on Friday, no major economic news. Now, as we come over and look at the Nasdaq real quick on the weekly chart, what do we see? We have a wick on the top. We also have a wick on the bottom, but we get a bearish engulfing candle, meaning we opened up higher than the close from the prior week, and we close below the opening price. Now we're going to see, will we start to get a little bit of follow through? MACD indicator still not yet crossed to the downside. Then we come over and we start looking at the daily chart. Notice on Thursday and Friday, both of those days, we did trade below the Fed. Then we got a little bit of a push back up intraday on Friday. Then we closed with a big wick on the top of that candle. Now, if we look at the DeMark 9-count indicator, you can see right here, boom, got busted. But now we're going to be starting candle number 4 when we open up the market out here on Monday. And we'll see, do we get, 4, 5, 6, 7, 8, 9, or do we simply bounce and run back towards all-time highs? Next, I want to come over and take a look at the VWAP real quick. I'm going to look at that VWAP right up there. You can see right now we were able to recapture that. I also want to look at the VWAP from the swing low here a little bit before elections. And you can see we're back above both those VWAPs. Can we essentially hold above it or not? We look on the 4-hour chart, MACD indicator just simply falling off a cliff. On the 1-hour chart, you can see the MACD indicator starting to come up. You can actually see that divergence playing out. You can see MACD made a low over here, which correlated with this consolidation down here. We break lower. MACD indicator simply did not make a lower low. Then we look out here on the 30-minute chart, we see a little bit more evident. Now, if we can stay holding above those anchor VWAPs, I do think we have a little bit more opportunity to the upside. However, we do have a minus development area, which really ranges from 517.10 all the way down here to about 515.10. That could be a key level. We'll see if we come down to it and then potentially bounce, because that minus development area could give us that anchor VWAP bounce as well. Then as we come over and we start looking at the futures markets real quick, what do we got going on the weekly time frame? We're able to close right above value area low, which comes in at 21,546.50. Point of control is way up here at 22,301.50, with value area high being up here at 22,450. Now, as I look at this chart, I'm asking myself, could this be setting up an inverse head and shoulder? Left shoulder, head, we start to come down a little bit and then form a right shoulder, and then we go ahead and take off, trying to go back and reclaim at least 50% of that candle. And if we get above that, we're likely going to undo that whole entire candle. Keep in mind, we have very poor structure out here on the profile. We have a huge minus development area, which is really going to play all the way in this zone. That goes anywhere from about 21,870 up here to about 22,040. If we start clearing above that, then I will start to turn my attention towards that point of control at 22,301. As we come over and start looking at the daily profiles real quick, my eyes automatically are gravitating right towards this minus development area. That's going to be somewhere in the ballpark of about 21,473 to about 21,400. We breached below that. I'll look for this basic structure retest that we broke out from, which will come in somewhere in the ballpark of 21,298. Also, if we were to pull a Fibonacci retracement, swing low up here to the swing high on Friday, notice that 50% level is still within our minus development area, and the 61.8 level is right near that structure breakout point that we have failed to come back and retest at this moment. Look at the daily profiles real quick. We have value area low at 21,281.25. We have the point of control up here at 21,751.25, with value area high being up here at 21,812.25. Now, if we do come down here and we simply bounce out of this area, that could set up a massive ABC pattern to the upside. And that would go something like this. A to B leg is an impulse leg, and we're going to go all the way down towards the 50% level, and that would bring us very close towards that point of control. That would bring us up here to about 22,203. Now, we also want to keep our eye on the dollar index. On Friday, we did get a bearish engulfing type of candle, but we do have this ABC structure that could be in play, which brings the dollar to about 110.13. That dollar going up, we'll probably see yields rising as well, and that would not be a favorable outcome for the stock market. We take a look at gold. Gold having a bullish day on Friday and really needs to get up and out this way. If we start going much lower than what we saw over the past 2 or 3 days, watch out. We're probably coming all the way back down towards the swing point down here at about 25.41.5. However, if we can start to firm up, regain above this high volume node, then we have a shot of coming back, retesting the swing point over here, then potentially making it right back towards all-time highs. Now, as we jump over and take a look at crude oil real quick, crude oil basically just stuck in this consolidation, cannot get out of its own way, can't go up, can't go down, eventually it's going to break. Think about this consolidation as nothing more than calls being built. Now, is it going to be calls to go higher or lower? The jury is out. We have to wait for the break, and then we'll see. Does the break hold, and do we continue to run? Now, if you guys like to learn how to automate your trailing stops, make sure to watch this video right here.